Good evening, colleagues. And today, actually, we are going to look at the standard IAS 19 employee benefit. And this standard actually it entails a lot. This standard is treated in Financial Reporting 3, University of Cape Coast School of Business, and for become accounting students, and also it is also a crucial area in corporate reporting and also advanced financial reporting. I would like you to subscribe to this channel as I have indicated there. Thank you. Lesson objectives. Now, within this standard, I stated earlier that for every standard, there are five things that we have to actually note within every standard. One is the scope of the standard, two, the objectives of the standard, three is the recognition criteria of that standard, four, the measurement and derecognition, recognition and derecognition, then measurements and presentation, then lastly disclosures. Yes, please. So that is what we have to take note of when studying a standard. So the lesson objectives: to define employment benefits. The second thing we are going to look at is to identify and explain the types of benefits provided for in IS 19. The last but not the least, or last but not least, to apply and discuss the provisions of post employment benefits, and lastly, to provide disclosure requirements. Now, let us get to know something small on an introductory part of the standard IS 19. It deals with accounting for all forms of consideration provided by an entity in exchange for services provided by employees or for the termination of employment. Being revised several times, most recently in 2011, and considers all employment benefits except share-based payment as a, that is IFRS 2. Employment offers pay and benefit packages due short term or long term. That is the problem. So this standard seeks to look or deal with accounting for all forms of considerations that are provided to an employee, even the time of employment and the time of termination of the employment. So, as in the retirement benefits, we consider all that. Yes, so that is basically the concept of employment or employee benefits. Yes, please. The objective of the standard IS 19 prescribes when cost of employee benefits should be recognized as a liability or expense. When cost of employee benefit should be recognized as a liability or expense. Actually, what do you think? What do you think? What is your view about this statement? What is your view about this statement? Is there any situation whereby an employee's benefits can become a liability or an expense? So we are going to look at the treatment for that. Also prescribes the amount of expense or liability that should be recognized. We also have to look at the definition of some terms. When we say liability in IAS 19, it refers to when employee provides services and the benefit is to be received in the future. Actually, this can draw your mind back to unearned revenue. Unearned revenue. That is revenue in advance. Unearned revenue. And expense, when employees enjoy benefits irrespective of when benefit is received by employee. When the entity enjoys benefit irrespective of when benefit is received by employee. We have several types of employee benefits, and the standard has actually identified four types of employee benefits. These are short-term employee benefits, post-employment benefits, that is the pension and the medical benefits that we get from retirement. Actually, post means after and pre means before. Yes, please. We have to take note of that too when doing employee benefits. Other long-term employee benefits, that is profit share, bonuses deferred, and sabbatical leave. Termination benefits, early retirement, redundancy payments to they are all types of employee benefit. Actually, this is this benefit that the standard had identified. There are other employee benefits that we know, but the standard limits us to actually these four types of employee benefits. So now let us go into them one by one. So in relation to short-term employee benefits, uh, there are benefits other than termination benefits. They are expected to be settled wholly before 12 months after the end of the annual reporting period in which the employees render the related service. Examples include wages and salaries, social security, paid sick leave, paid annual leave. Post employment benefits. Employment benefits other than termination benefits and short term employee benefit that are payable after the completion of the employment. You see, so actually, post is after. So they are the employment benefit that are payable after the completion of employment. Examples include pension monies and medical bills. Other long-term employee benefits. These are all employee benefits other than short-term employee benefits, post-employment benefits, and termination benefits. So examples include profit share, bonuses deferred, and sabbatical leave. The last benefit we talked about was termination benefits. These benefits are provided in exchange for the termination of an employee's employment as a result of either A, an entity's decision to terminate an employer's employment before the normal retirement date, or B, an employer's decision to accept an offer of benefit in exchange for the termination of employment. So please, these statements we have to take note of them. So it said the termination benefit is provided in exchange for the termination of an employee's employment as a result of either A, an entity's decision to terminate an employee's employment before the normal retirement date, or B, an employee's decision to accept an offer of benefit in exchange for the termination of employment. An example includes early retirement, because actually you have not reached the retirement date. That's the first situation. It has not gotten to the normal retirement date, but the employee, the entity seeks to um terminate the employment deal with the employee. And the second point is also saying an employer's decision to accept an offer of benefit, an employee's decision to accept an offer of benefit in exchange for so the employee will actually um, terminate the employment contract in exchange for any other benefit to be received, maybe a redundancy pay or something else. Yes, so that is a termination benefit. So any benefit related to an employee terminating the employment contract is termed as what we call the termination benefit. So let us look at an example of a short term. A company gives its employees an annual entitlement to paid hospital leave. If there is any unused leave at the end of the year, employees are entitled to carry forward the unused leave for up to 12 months. At the end of 2018, the company's employees carry forward it carry forward in total 50 days of unused holiday leave. Employees are paid 100 Ghana cedis per day. Employees are paid 100 Ghana cedis per day. Okay. And in total 50 days. Okay. So required. Explain the required accounting treatment. So it is rather supposed to be the required accounting treatments for the unused holiday carry forward. So this actually is a trial work. Actually, if not going to the standard itself, so we will get the standard itself and we'll come back to this question. The marker is falling. The marker is disturbing me. This event. Okay, don't worry. But let's just take note that it is a trial work. So we'll come back to it. Post-employment benefit plans. There are two main types of pension plans. And let us get to know them. So we have defined contribution plans, employer defined contribution plans, and defined benefit plans. Other than defined contribution plan, DCP actually means defined contribution plans. So now let us get to know what we mean by defined contribution plans. Defined contribution plans. Employer pays fixed contribution into a plan, no further legal or constructive obligation. So with a defined contribution plan, it is fixed. There is a fixed contribution into a plan, and there is no further legal or constructive obligation. The contribution by both employer and employee. So it is also a contribution made by both the employer. Oh, why is my marker disturbing me? So it's a contribution made by both employer and employee. So actually we have in taxation, if we study pension schemes, we have um, 13.5% um, paid by the employer, so 13.5% tie. Yeah, so 13.5% tie, ERTIER. Then actually the employee will pay the 5.5%. 5.5%. So this is the social security SSF, the SSF, and, and this is the one paid by the employer. So that is how a defined contribution plan is like. So that is what we have to take note of. I'm sorry for design the screen. I want to make you understand. And we have defined benefit plans other than defined contribution plan. Payment normally depends on final salary. Payment normally depends on final salary or some average that is worked out. Employer has ongoing obligation to contribute to the fund to meet the defined benefits. Employer has outgoing obligations to contribute to the funds to meet the defined benefits. So actually, it is not a contribution made by both employer and employee. Here, it is only the employer who has the obligation. The employer who has the obligation to do that. So that is what we have to take note of. Accounting for post-employment benefit plans. Accounting for defined contribution plans, we have to note these things. Charge the defined contribution plan pension contribution to profit or loss as an expense in each period, normally same as amount of contribution paid. So charge the agreed pension contribution. So as I was saying, these things you can find them in taxation pension scheme as a topic on its own. So pension contribution. So charge agreed pension contribution to profit or loss as expense in each period, normally and same as the amount of contribution paid. And the second treatment is um, it will be treated an asset or liability for pension only arises when cash paid does not equal the contribution for the period. So there will be an asset. If the cash paid is less than the pension contribution. There will be an asset if the cash paid actually is less than the pension contribution, and there will be a liability if the cash paid is more than the uh, so, and vice versa. So we have to note that. So there will be an effect of asset or liability due to the differences in the cash paid and the contribution um, or the pension contribution that will be obligated to be paid. Yes. Disclosure is required for amounts recognized as an expense in the period. So we have to disclose at the end of the financial year. So define contribution. An entity makes contribution to the pension fund of employee at a rate of 5% of gross salary. So 5%. So please let's take note of this. 5% of gross salary. For convenience, the entity pays um 10,000 per month. So actually um per month into the pension scheme. So this is the amount that they pay into the pension. That's the pension contribution, with any balance being paid in the first month of the following accounting year. So it means we have to find actually 5% of this amount, because this is the wages and salaries for 2018. So if we find 5%, so that would be 5% of 2.7 million. Yes, 5% of 2.7 million, and we will get the answer and compare it with the 10,000 Ghana cedis per month. Actually, this one is for 2018, so it means for a year. So we have to find per month, or we can multiply this by 12 and make it for a year, then compare. So that is it. So accounting for defined benefit plans. An actuary calculates the amount to be paid. Calculations are based on estimates and assumptions: life expectancy, return on investment, that's ROI, wage inflation, etc. If liability exceeds the assets, and deficit and therefore liability in the statement of financial position, vice versa. So if asset exceeds the liability, it becomes surplus and therefore an asset in the statement of financial position. Liabilities measured at present value of defined benefit obligation using projected unit method. Planned assets measured at fair value refer to IFRS stating that is fair value measurement. Fair value measurement. So actually, this is the format that we have to take note. The defined benefit plan movements. So we start with the net deficit or surplus brought forward. So if it's a deficit, and uh, we put that in a bracket, and if it's a surplus, it is not in a bracket. Net interest component, we can have a negative balance and a positive balance. Service cost component, we have X being indicated there. Contribution into plan, it should be a negative balance. Benefits paid, that is if any, remeasurement balance figure. It can be a positive or a negative figure. Then we get our closing net deficit or surplus. So actually the net deficit is rather positive balance and the surplus is a negative balance. If net surplus is achieved, that is into bracket net assets, remember to perform asset ceiling test. So we will get to the asset ceiling test. We are going to do the asset ceiling test. Okay. So define benefit obligation. Plan obligation format. The planned obligation format. So the format for the planned obligation, it is present value of defined benefit obligation brought forward. You add interest cost, any interest cost. You add service cost components, and you less benefits paid. Then if there is a remeasurement, that is the balance figure, you bring it here, either a negative balance or a positive balance. Then you get your present value of the defined benefit obligation carry forward. Defined benefit assets. So planned asset format. That is fair value of planned asset brought forward. You add interest income. So see here we added what? Interest cost. So it means here we are going to add what? Interest income. Then here is more like a liability. Obligation, liability goes with obligation. L goes with O. Obligation. Right. Yes. And asset goes with what? Economic benefits. So fair value of planned asset brought forward, interest income, contribution into plan, contributions into plan. But see here, yes, service cost components, benefits paid. So actually it's like contributions paid. So here too we have benefit paid, but here the benefit paid here is different from the benefit paid here. Yes. Then remeasurement balance figure, that's either a positive balance or a negative balance. You bring it there, then you sum them all up to get your fair value of planned assets carry forward. Components of defined budget plan explain. We have net interest, and you see there were certain components here that we mentioned. Service cost. The net interest is charged or credited to profit or loss. Discount rate applied to net deficit or surplus. You debit income and credit defined budget obligation, and vice versa. Service component charged to profit or loss and made up of three components, that is current service cost, past service cost, charging plan obligation due to amendments or curtailments. Then we have gain or loss on settlement. So the treatment is debit income, the profit or loss, and credit defined budget obligation. Defined benefit obligation. Yeah. So now let us look at the current service cost. With the current service cost is an increase in the present value of obligation arising from employee service in the current period. It is an increase in the present value of obligation arising from employee service in the current period. So we are looking at current service cost, current the service cost you've incurred currently or in the current period. Then the past service cost a charge is a change, a change in the present value of obligation for employee service in prior periods resulting from a plan amendment or curtailment. So it is a change in the present value of obligation for employee service in prior periods resulting from a plan amendments or curtailments. So it is a change in the present value of obligation for employee service in prior period resulting from a plan amendment or curtailment. Gain or loss on settlement. Gain or loss from settlement due to transaction to eliminate obligations for part or all of the benefits under plan. Gain or loss from settlement due to transactions. They are due to transactions to eliminate obligation for part or all of the benefits under a plan. Contributions into the plan. Cash paid into the plan. Cash paid into the plan. That is the contributions into the plan. And I said that these contributions into the plan are in two ways. If we check, if we come back here and we check, we have contributions into the plan, and here is negated contribution into the plan, but here is a positive figure. So cash paid into the plan, that is the contribution into the plan, and no impact on statement of profit or loss and OCI. So it doesn't have any impact on statement of profit or loss or OCI. No statement of profit or loss or OCI. So let's take note of that. No statement of profit or loss or OCI effect. Thank you. So debit defined benefit assets and credit entities cash bank. Debit defined benefit asset. That is why they define benefit asset, because it's an asset, it has a debit balance. So if it is going to be debited, it means it will add up to the cash there. Then you credit the entity's cash or bank. Credit the entity's cash or bank. Benefit paid. Benefit paid. Amount paid out to retired employees and reduces both plan obligation and plan assets. No impact on statement of comprehensive income. No impact on statement of no statement of comprehensive income. So it doesn't affect statement of comprehensive income. So it is amounts paid out to retired employees and reduces so it is an amount paid out to retired employees and reduces both plan obligation and plan assets. So it affects both plan obligation and plan assets. Let's take note of that. So it means with plan obligation we are going to debit it, and with plan asset we are going to credit it. A reduction in both assets and liability. Remeasurement component OCI and will not be reclassified. So remeasurement component is classified under OCI and needs no reclassification. We don't reclassify. So let me make it clear here. So O OCI not reclassify, RC reclassify. So this is what we call the asset ceiling test. Yeah. So actually we recall that we mentioned the asset ceiling test in one of the practical questions. Please let me draw our minds back to this place. So here it is. Okay, let me see. Have I passed by it? Or okay, so this is it. If net surplus is achieved, net assets, remember to perform asset ceiling test. So we have gotten to that part. So let us know how the asset ceiling test is done. Asset ceiling test. A net surplus or assets can be recognized to the extent that it can or will be recoverable through refund or reduction in contribution. A net surplus or assets can be recognized to the extent that it can be or will be recoverable through refund or reduction in contribution. It is measured at the lower of net assets and calculated and the total of any cumulative unrecognized actual losses and past service costs plus present value of future refund and reduction. Please let's take note of this. It is valued or is measured at the lower of net assets, net assets as calculated, and the total of any cumulative unrecognized actual losses. So lower of lower of sorry, the space is very small for, so you let me write lower net assets, then cumulative unrecognized actual losses. Yes, so that is what we have to, so we have to measure that and determine the asset ceiling test. So now let us note the representation of the asset ceiling test. How do we interpret it? That is what we want to know. Okay, so I'll make a new video on that, how the asset ceiling test will be represented. Thank you for your time and thank you for watching this video. Please subscribe to this channel. Subscribe to this channel. Subscribe. Thank you.